Hi there, and welcome to our finance terminology series. In this lecture, we're going to look at how to analyze an income statement from a financial analyst perspective. If you recall, in the previous lecture, we defined an income statement as a representation of a company profit and loss statement. So the goal today is to give you a framework, a step-by-step process on how you can analyze an income statement just like a professional. So, step number 1, make sure you review your company growth rate. Step number 2, make sure that you understand your company profitability in the form of margins. And step number 3, make sure you apply comparable analysis where you're comparing your company growth rates and margins with its peers and competitors to determine whether they are underperforming or they performing above its industry peer group. So let's look at an example. Here we're displaying the income statement of XYZ Pet Inc. They manufacture pet food and toys, anything related to your pet. So when we apply our simple 3-step to analyzing an income statement, if we look at number 1, growth rate, top line revenue growth, you can see that this company is growing revenue consistently and it's increasing, it's accelerating. If we look at the bottom line, net income growth, you can also see that generally speaking, it's increasing. So the higher the revenue growth, the better, because it validates that they have a valuable product and service, and consumers are essentially purchasing that product and service, therefore validating that this company actually has a good value proposition for its consumer. Again, the higher the growth, the better on the top line and the bottom line. In the second step, if we look at company margins, their level of profitability, we concern ourselves with gross profit margin, EBIT margin, and net income margin. Generally speaking, when looking at this company income statement, their margins are expanding. This tells us that from an operating standpoint, they are reducing their expenditures. They're being more efficient. They're generating more profits. If we look at it from a simplistic standpoint, per every dollar of revenue that the company generates, if we look at the year 2020, looking at EBIT, you can see that they're generating 64% EBIT margin. In other words, every dollar of revenue that they generate, they are keeping 64 cents. So the higher that margin is, the better, because then they can use that to invest in the company. And then when you look at the bottom line, after subtracting your interest expense, your taxes, that net income is the claim that we have as investors, as shareholders, and we can perhaps anticipate a dividend in the future. This is why margins are so important. The higher the margins, the better the operating efficiency in the business, and the happier that we will be as financial investors in the business. Now, if we look at step number 3, comparable analysis, you're gonna see that we can compare our company's operating performance from a revenue standpoint and from a profitability standpoint. So here we're illustrating the comparable analysis of our hypothetical company, XYZ Pet Inc. So we're breaking this down into components. The first one is illustrating the growth rate of our company relative to its peers. Notice that revenue growth, EBITDA, and EBIT growth is actually higher than the industry average or higher than their peers, indicating to us that their customer is validating their product and service. That's why their growth rate is much higher. So any company that you might be analyzing, one of the important metrics or variables to look at is growth. Make sure you're comparing it with their peers, and the higher the growth, the better. The other part, or the other component, is the profitability. Look at our company. They're actually more profitable than the industry on a gross profit basis, on an EBIT basis, and on an EBITDA basis. The higher the profitability of your company, the better, because the information, the financial performance or the financial results it's releasing is telling us that they're more efficient at running their business. Their expenditures are less. They are generating more money while maintaining their costs at an effective or an efficient level. That right there is maximum profitability on any business that you may want to consider. So this is a very clear, defined example from a simple approach of how you can apply revenue growth and margins when comparing it to their peers. Now, let's look at a real example. Let's look at Amazon. Here we are now illustrating the income statement of Amazon. Look at the revenue growth of Amazon. It's growing double digit. Look at the profit margin. Notice that it's actually increasing over time. And then if we look at the bottom line, we look at margins, you can see that some of these margins like net income is actually increasing. But it's our job as financial analysts to interpret this information and try to understand the story behind the numbers. And you learn the story behind the numbers by performing due diligence, looking at the company press release, reading their SEC filing, and paying close attention to what management is telling us about the nature of its business so that we can better understand the financials and put behind it the story and the explanation. So this is a just clear representation of how we apply step number 1, company growth rate. Step number 2, the margin, so that we can see if margins are expanding, contracting, and also if revenue is increasing at a reasonable rate. Now, let's look at Amazon, comparing them to their peer group. How are they performing? Are they below the industry average? Or are they above the industry average? So here we're illustrating Amazon comparable analysis. We're looking at revenue growth and we're looking at profitability margins. Look at year 1 revenue on a last 12 months or LTM basis. Amazon is growing faster than the industry. On an EBITDA basis, same story. And also on an EBIT basis, same story. So we can see that Amazon is growing faster than the industry average and their peer group. And obviously, they've developed an amazing business model with their e-commerce website. On the profitability side, look at gross profit margin. They are slightly below the industry average. Look at EBITDA margin. They're slightly also below the industry average, and also EBIT margins, they're below the industry average. Now, because Amazon is growing faster than its industry, the anticipation, or how we interpret this information from a financial analyst standpoint, is that Amazon's ability to grow will eventually allow them to get their margins in line with the industry and perhaps exceed the industry margins because they have the growth behind it. So you should apply this exercise, this example, on every company that you're looking at, especially if you're looking into buying their stock. So let's recap what we've done up to this point. We gave you a step-by-step process, 3 important steps in analyzing an income statement that you should concern yourself with from a financial analyst perspective. Step number 1, make sure you pay attention to the company growth rate, top line and bottom line, because this gives us information on how much demand there is for their product and service. Step number 2 was examining the company profitability, their margins, gross profit margins, EBIT margins, EBITDA margins, and net income margins. The higher, the better, because it's an indication that the company is very efficient at controlling costs and generating more revenue. Per every dollar of revenue that comes in, how much are you keeping? Okay? And then step number 3 is comparing our company financial performance with its peer group. Are they below or above the industry average, giving us an indication of where our company ranks within their entire industry? The higher they rank, the better, because it's a best of breed company. All right, folks, so I hope you enjoy and found value in this brief explanation on how to analyze financial statement. So with that being said, I'll see you in the next one. And if you're a student or an individual looking to further develop your soft and technical skills in stock analysis, then don't forget to check out our financial analyst and investment banking training course, where we design a very structured curriculum with over 90 hours of video lectures, 7 financial modeling assignments, and 4 investment case studies designed to teach you the right process. So what are you waiting for? Enroll today and start analyzing companies like a professional.